Good morning, everyone. Thank you all for joining us today for the seventh session of the Luxembourg Sustainable Finance Seminar Series, organized by the Faculty of Law, Economics and Finance of the University of Luxembourg and the Luxembourg Sustainable Finance Initiative. My name is Lorenzo Vico, and the Deputy CEO of the Luxembourg Sustainable Finance Initiative, Luxembourg's coordinating entity of sustainable finance. For the ones who do not know us, the LSFI is a non-profit organization founded in January 2020 by the Ministry of Finance, the Ministry of Environment, Climate and Biodiversity, Luxembourg for Finance, and the High Council for Sustainable Development, with the mission to drive change across the whole ecosystem as a center of excellence and knowledge hub, supporting the financial sector to accelerate financing of the transition and measuring progress. It is my pleasure to welcome you to this session entitled From Concepts to Markets, Understanding Carbon Credits and the Evolution of this Market. Today, we are here to explore how carbon credits are transforming the landscape of sustainable finance and how they contribute to the transition to net zero emission. First of all, I would like to extend a warm welcome to our speakers and panelists. Michael Holling, Professor of Finance and Chair for Sustainable Finance at the University of Luxembourg. Ineki Kiers, who leads the financial setup of smallholder agroforestry finance. Chris Leeds, Head of Carbon Markets Development at Standard Chartered Bank, and Dr. Michael Haltoff, CEO and CIO at Luxembourg Enterprise for Investment and Wealth Management. Our agenda for today will include first, an introduction to carbon credits and carbon markets by Michael Holling, then a panel discussion where we get insights from Ineke, Chris, and Michael. And finally, a Q&A session where you will have the opportunity to engage directly with our speakers. Please post any question you might have during the event in the chat, and I will make sure to bring it up at the end. So without further ado, let's get started. So Michael Allen, the floor is yours.
Excellent. Thank you very much. Lorenzo, can you just confirm that I'm hearable, that you hear me?
We can hear you well.
Perfect. Very good. Thanks a lot for having me, and thanks to all of you for participating and attending this webinar. It's great to be part of it. I think on a very, very interesting topic. Over the next, let's say, 15 minutes or so, I'll try to give a quick introduction to carbon credits and carbon markets, just to set the stage without stealing too much time from the panel discussion, which obviously is the focus of today's event. In terms of topics, I would like to cover the following 4 topics briefly in this short talk. First, we'll talk a little bit about the economic foundation of carbon credits. So, where's this idea coming from? What are the underlying motivations? We'll introduce the European emission trading system. For obvious reasons, is a very important one, the oldest and largest one, and obviously also a very relevant one for us in Luxembourg. We'll talk then, we move over to the investor perspective, reflecting a little bit on primary and secondary emission allowance markets. So how are these allowances created and how are they traded? And then conclude by setting out a couple of characteristics of carbon prices, again, with the idea to set the stage for discussion about investment opportunities in this market. Now, obviously, if we think about carbon markets and carbon credits, this idea goes back to one of the most fundamental issues in environmental economics and of the issues underlying the transition to more sustainable economies and societies. It's this notion that obviously by emitting greenhouse gases or CO2, carbon dioxide, there are negative externalities that we impose, but these negative externalities currently are not priced, so they don't have an explicit, or at least they didn't have an explicit price tag in the past. And so the idea of carbon markets or carbon credits is to change this. And so they represent a market-based approach to determine what economists call the social cost of carbon. So precisely these negative externalities that carbon emissions impose on society through climate change and other negative consequences. So the overarching goal, obviously, of these types of markets is to speed up or to make the transition happening by making emissions more costly and through this mechanism incentivizing firms to reduce their emissions. Now, this again goes back to a long and very extensive literature in environmental economics. One of the names that always comes to mind here and should be mentioned briefly also in this introduction is obviously Nordhaus, who has a sequence or a whole series of papers and eventually also received the Nobel Prize back in 2018. There's still a lot of debates going on about these economic foundations, which are oftentimes centering about the issues about how effective individual implementations are. The focus of today's webinar is on carbon credits and carbon markets. So that's a market-based solution for this problem of finding the social cost of carbon. An alternative approach are carbon taxes, which you also see implemented in some countries. And finally, also maybe a more recent development about the creation of carbon offsets. So it's still a bit of a debate and question about how effective, how efficient each one of these approaches are, because obviously we would like to implement those approaches that are most effective and most efficient. A more recent literature actually also looks at the interaction between these kind of considerations and another aspect that is oftentimes mentioned in the context of the transition, which is green finance. So that's basically the idea to reallocate your capital away from brown firms towards green firms, which is something that, of course, is very prominent, has received a lot of attention, maybe even more attention than carbon markets over the last 5 to 10 years. But of course, also interacts with this notion of carbon markets. And so recently there has also been a debate about whether these approaches complement or substitute for each other. Now, to conclude this very, very brief sort of kickoff in terms of the economic foundation, ultimately, I wanted to share a little bit or some empirical evidence about whether these markets actually work. So whether carbon markets contribute to the transition, speed up the transition, reduce emissions. Over the sort of originally, the evidence here was quite mixed, and there was research that basically was on the positive side or on the negative side. I would argue that most recently, some very prominent and very well published papers, only sort of last year, actually have established in a very credible way that these markets do help the transition and do lead to reductions of emissions. So I've included two of the most prominent ones here on the slide, where the first one on top actually looks at an international sample of these carbon markets and finds that, for example, if we focus on carbon dioxide, that these carbon markets led to reduction of carbon dioxide emissions by 18%. What is also interesting to stress here that these reductions are achieved by cutting the use of fossil fuels, as well as by boosting renewable energy. So this paper also looks into how these reductions are actually achieved. And finally, as I mentioned earlier, it also addresses this issue that this paper at least comes to the conclusion that carbon taxes are not as effective in reducing emissions as carbon markets are. Another study that is particularly relevant for our context because it focuses on the European ETS system is the Colmer et al. Study that actually finds a similar reduction in carbon dioxide emissions. What I think is particularly important in that context is that they are also able to assess whether these reductions have been associated with any reductions in economic activity or any contractions in economic activity, so whether there were any economic costs that these firms had to bear because they reduced their emissions. And I think the very positive and supportive conclusion of this paper is that that's not the case. So there were no detectable contractions in economic activity related to these emissions. So it was not costly in terms of an economic output measure for these firms to reduce their emissions. What I think is also interesting to see is that some of these fears that are often brought up in the context of these markets, that firms will just move away to markets that are not regulated or move their brown assets to firms that are not covered by the regulation. Also, these behavior or these patterns do not seem to be found or not seem to be represented in the data according to this study. Right, in contrast, what they document is that these emission reductions have been achieved through targeted investments, which I think overall is a very positive conclusion. And so I think overall the most recent high quality sort of academic literature would suggest that these markets are successful in reducing emissions. Now, whether we are satisfied with a reduction of, let's say, 15 to 20% or not is a different question, but at least in terms of the direction, there's evidence that these markets seem to work. Now, moving away from the economic foundations, more towards a specific example of an implementation, and not just any, but the European emissions trading system, which is the oldest and the largest of these cap and trade systems in the world nowadays. So here, the term cap and trade indicates that basically in these systems, usually allowances or permits are issued that represent the cap, basically represents the total number of emissions that are tolerated in a given year. And then these allowances or permits are also traded because different firms might have different demand for these kind of allowances, and that's the trade part in the cap and trade name. Currently in the European trading system, the projection of the cap is determined in a way that in 2030, the cap for the emissions will be 62% lower than the 2005 emission levels. To give you some idea about the reduction path that the system is currently trying to implement through this emissions trading framework. Now, in Europe, this is a mandatory framework, so participation is mandatory for certain firms. So size matters, but then most importantly is the sector that these firms are working in or operating in. So these are power stations, manufacturing plants, and aviation, among others. And the idea of these allowances is very simple. At the end of a year, ETS firms, so firms that are subject to this system, must surrender an allowance for each ton of CO2 equivalents that are emitted during the year. And if the firm is not able to deliver the appropriate number of allowances, it will have to pay quite severe fines. And therefore, firms have an incentive or a necessity to basically acquire these allowances. Now, the ETS has been in place for quite some time. And if we look at the evolution, one clearly sees that designing the system in a way that achieves these goals that we sort of set out with a couple of minutes ago was not that easy. So it went through different phases. Again, we're not going to go through all the details here, but basically a main determinant of these different phases is how initial allowances are allocated to the firms that are in the system. And initially in phase one, these allowances were allocated for free. So firms were basically given these allowances without having to pay for them. And the number of these allowances were very high, so exceeded basically verified emissions, which resulted in the case that in the end, the carbon price observed in the market, so to speak, was not very distinguishable from zero and never really took off. So then over the next couple of phases, basically this free allocation of allowances was changed, was reduced, and the default system became an auction, which is something that I will touch upon a little bit in more detail later on. So that's the primary market for these allowances, where these allowances are issued. And now the default system is that firms have to basically bid for these allowances in an open auction and therefore also pay a price to observe them. Still, a problem early on in the system was that because of the initial excessive supply of these allowances, the total number of allowances in circulation was still high because these allowances initially were bankable, so they did not expire at the end of the year, but you were able to transfer them to the next year and sort of store them. And that led still to an excess supply. So even in phase 2 and phase 3 of the development of the system, the price of carbon never really took off and remained relatively low. Finally, in phase 4, an important governance mechanism was put into place, the so-called Market Stability Reserve, which now is a mechanism to explicitly manage the supply, not only through the issuance of these carbon credits, but also through other means, such as, for example, canceling existing carbon allowances to basically counteract this behavior of banking or storing old allowances for the future. And once this system was in place, as we're also going to see in a few minutes, prices of carbon actually took off, became sort of positive, even substantially positive, and actually also reached a maximum above 100, slightly above 100 in early 2023. In terms of the size of the European emissions trading systems in 2023, just to give you an idea, it covered, roughly speaking, 11,000 installations within the European Union member states, plus Iceland, Liechtenstein, and Norway. And they accounted for, roughly speaking, 40% of total European Union emissions. This makes it the largest cap and trade system worldwide. Currently, or in the year 2023, the reduction factor by which the cap shrinks from one year to another is currently set at 4.3%, and if I'm not mistaken, is also determined to increase further in a couple of years in order to have an even steeper reduction of the cap. Now, just to give you put this a little bit into the context before we move over to the investor perspective for the last couple of minutes. So here, internationally speaking, again, as of 2023, there was a survey by the World Bank where they identified 27 of these schemes worldwide, globally speaking, that in total covered, roughly speaking, 18% of global carbon emissions. In comparison, carbon taxes are only used or only sort of covering around 6% of global emissions. So one might still be maybe disappointed that both of these systems do not cover more global emissions, but relatively speaking, the market-based approach clearly dominates the tax-based setup. One example for a different jurisdiction where you also have a cap and trade system is California, which I guess in today's world might be interesting to monitor how this is going to play out with the Trump government. Now, coming to the investor perspective for the last couple of minutes, as already mentioned, so we'll basically go through this discussion by market. So the primary allowance market is the market where these allowances are issued. As said earlier, originally or historically, these were issued for free. Now the default is that these are issued in public auctions that take place very regularly on a weekly, multiple days per week during the year, where basically firms that are subject to the European ETS, but also other investors can potentially participate in these auctions and buy allowances. Then there is, and also sort of just to clarify, there's still some free allowances that are issued, and these vary quite a bit across individual firms and particularly sectors, where the broad motivation for this free allowance, the issuance of free allowances, is that some sectors have a hard time reducing their emissions because abatement costs are very high, or the technology for abatement does not even exist, such as, for example, the aviation industry. And in these industries, the regulator decided to still issue quite a substantial fraction of allowances still for free. Now, if we move on to the secondary allowance market, then in the secondary market, now we come to the trade part. To put it in perspective, in 2022, a total of 486 million allowances were auctioned. So in the primary market, you had 486 million allowances. So the cap of CO2 emissions was set to 486 million tons. The trading volume in the spot market, so basically the trading of these allowances directly in the spot market, was slightly less than twice this amount. So it was roughly around 750 million emission allowances. That in terms of prices, secondary market prices closely mirror auction prices, so frictions between the original issuance and the spot market seem to be very small. However, in terms of an investment perspective, the most liquid market and certainly the target market for carbon allowances is not the spot market, but it's the futures market, similar to other sort of commodity markets. If we look at the futures market, then in terms of size, it's an order of magnitude larger than the spot market. In 2022, for example, there were 9 billion allowances traded in the futures market, which accounted for 87% of the total trading volume in all markets for these allowances. Due to this bankability that I mentioned earlier, to the low storage or non-existing storage costs for these allowances, future prices and spot prices are usually tightly linked. Again, a futures price, right, gives you this, basically allows you to buy or sell the allowance at a future point in time. When that is sort of, the term structure of these prices, if you go further out along the time, or if you're more in the sort of shorter future or next nearer future, then here any price differences usually can be related to the funding cost or the interest rate levels. So there's no other kind of characteristics that usually drive a big wedge in terms of futures prices and spot prices. And the futures market is a physical market. So in here, basically, whenever the futures get settled, it actually means a real exchange of the underlying allowance. Finally, there's also an option market that has developed for these allowances, which also offers investment opportunities to investors. These options now, obviously don't give you the obligation, but they only give you the right to buy or sell a futures contract on these allowances in the future. So they are particularly useful, products, as one can discuss in other contexts, for hedging and speculation, but also here in the context of allowances. And we also see that this option market has picked up quite a bit over the last couple of years and has reached, I would say, a sizable and substantial size with sort of reasonable numbers in terms of trading volume. Finally, to kind of conclude this brief introduction to these markets, if we look at the carbon prices, so here you see a plot for the last 10 years. I think the 72 was the price last Friday, if I'm not mistaken. You see that early on the price was relatively low and moving mostly sort of sideways at low levels. And then you see kind of like almost a step function when there were different changes between the different phases until sort of recently, let's say just around COVID, which of course was the COVID crisis, but then also this implementation of this market stability mechanism that then led to a steep increase in these prices, and actually also quite some volatility, which is maybe the one characteristic that I also would like to highlight, and you'll see even some more evidence on this on the last two slides, is that actually carbon prices appear to be relatively volatile, and I'll be more specific on this in a second. Just maybe to sort of wrap up this discussion about where these allowances are coming from and sort of what the underlying motivations are. If we think about the price, foundation, sort of the foundations for these prices, then of course, as in any other market, they're driven by supply and demand. Here, some of these aspects might be specific, right? Given all the considerations that we just discussed about the supply, which is determined by the regulator, which is, exposed obviously to political changes and political developments. In terms of the demand, here, of course, the demand for these allowances is driven by economic activity. The more economic activity brown firms have, the more they emit and the more they need to look for allowances. And similar, of course, it's also driven by the cost of emission abatement. How easy is it for firms to reduce their emissions and invest in green technology? So the final point to make is that I think one aspect that, at least in terms of the academic literature, people have focused on in terms of specific characteristics of carbon prices is that carbon price uncertainty seems to be relatively high. So there's a recent paper that studies this in quite some detail, and they find, for example, that the annualized allowance futures return volatility is between 45 and 55%, which, for example, if you compare it to the S&P 500, is twice the level that we see in, let's say, well-developed equity markets. What this study also finds is that the carbon price uncertainty itself varies over time. So there's basically different regimes in these carbon prices where volatility increases or decreases. Again, it's maybe not too surprising given how we discussed a little bit the historical evolution with these different phases and how regulation sometimes has an impact on, particularly the supply, but through the supply also on these prices. And finally, this paper also finds that the uncertainty is, of course, related to overall macroeconomic uncertainty, right? Think about how the demand for these allowances is driven by economic output. But actually, the correlation between a volatility measure such as the VIX for the equity markets and the carbon-based volatility measure is relatively low. That means the uncertainty or the variation in carbon prices seems to be driven by other aspects, other considerations than overall macroeconomic or equity volatility, which I think potentially offers quite some interesting opportunities for portfolio construction, exploitation of diversification, if investors consider investing in carbon assets in addition to their traditional portfolios. Here's just a graph about how this volatility of the carbon market has evolved over time, where these authors also sort of highlight some of the peaks, which I think is intuitive, but also shows that there's substantial variation in the volatility that we observe in these carbon markets. So to conclude and to not take any more time away from the panelists and the panel discussion, I just wanted to basically stress that carbon markets have definitely grown and established themselves as relevant players, globally speaking, and in particular in Europe over the past couple of years. there is quite some evidence that they contribute an important component to the transition to green economies and lead to reductions in emissions. At the same point in time, I think these markets have developed in terms of size and liquidity, and therefore also offer interesting opportunities for investors. Thank you very much. And now back to Lorenzo for the panel discussion.
Thank you very much, Michael, for this insightful presentation. And now let's move on to the panel discussion with our guests, Ineke, Chris, and Michael. So before delving into the discussion itself, I would invite you to briefly introduce yourself and your activity. Ineke, let's start with you.
Thank you, Lorenzo. Nice to be here. Thanks for inviting me. My name is Ineke Keers. I'm the head of, responsible for the investments, director investments at SAF, Smallholder Agroforestry Finance, which is a new entity that is looking to finance agroforestry projects for smallholder farmers all across the global south. Thanks for
Thank
inviting
you
me.
very much. Chris.
Hi, yes, and thanks for having me on the panel today. Great group to be amongst. So my name is Chris Leeds. I'm the head of carbon markets development at Standard Chartered. I'm also on the board of an organisation called the Integrity Council for the Voluntary Carbon Markets, the ICVCM. So my role is at Standard Chartered is to develop our carbon market capabilities. We're a big trader of the EU ETS. We started trading the ETS about 3 years ago and have rapidly built our capabilities and our presence there. We're trying to build that across other markets, and we can talk about that in a minute. What we think about the other compliance markets. We've also been trying to build up the voluntary piece, the project-based markets, as I try to refer to them as, and again we'll probably talk about that a bit in a minute. We were very heavily involved in something called the TSVCM, the Task Force for Scaling the Voluntary Carbon Markets. And in fact, our CEO, Bill Winters, was the chair of that at the time. He's still heavily involved and very supportive of carbon market developments. And the bank itself is very supportive of sustainable finance and the transition, the energy transition. We just recently released our own transition plan, which you can see online. And then obviously that's one of the reasons why I got involved in the ICVCM, because that was set up through the TSVCM. And we're working very hard to improve the quality of carbon credits, of project-based carbon credits. Recently released our latest assessment of various project methodologies, and there'll be some more news coming out, I think, in the next few days around some of the latest assessments that we've been involved in. So yeah, really pleased to be here and looking forward to the debate.
Thank you very much, Chris. Michael.
Hello. Do you hear me well?
Yeah.
Wonderful. Yes, I'm Michael, Lave Management. We are based in Luxembourg. I come from a private credit management background. I worked for a long time as a portfolio manager, and we want to bring these investment solutions to the verified carbon market, so project-based carbon credits, rather than what we previously discussed here, the allowances market. And here we have one focus on nature-based carbon removals, as well as later on carbon allowances. So that would be, reforestation, afforestation, these type of projects, and also tech-based. On the other hand, we are also working in the sustainable infrastructure sector, where optimization of, let's say, energy supply for business centers, small island problems, etc. So this is really our focus. We have a very strong tech approach, because it's very key for these markets to have a high level of transparency. It's required by most regulators, as well as in the recent directive by the EU, or regulation by the EU. And so we have a strong focus on that, digitalization, as well as data management to facilitate our tasks.
Thank you very much, Michael. And thank you very much to all of you for introducing yourself. So to start the discussion, I have a question for the three of you. So with COP29 introducing new regulatory benchmarks, how do you each see the evolving regulatory landscape impacting both compliance and voluntary carbon markets? Please. Do you want to
Who's
start?
going first?
Yeah, happy to start. Look, I think one of the important things that came out of well, there were many important things, but the two that I took away was, number one, this for me finally put to bed the idea that that there was any issue philosophically around carbon markets at all. And in fact, I was really interested to hear that presentation. There's some important points made there. But I think that really said, look, 190 odd countries, however many it is now, agreed this Article 6 of the Paris Agreement. So this was the mechanism under the Paris Agreement that's taken 10 years to put in place, but nevertheless we have, and it actually underpins the principle of carbon trading, and the idea that actually two economies, corporates, whatever, can both trade and both be better off after the trade, and it will help to accelerate the transition, and also to do it at a least cost, take a least cost approach to it. So I think that's a really important point. The other important point was, of course, the agreement that was made around the financing, the gap in the financing, and the commitment, or the commitment to finance or provide finance of 300 billion by 2030 and 1.3 trillion by 2035. But what's really clear as well, and we've seen this in the last few weeks and months, is that much of that finance in the past has been coming from the public purse, from governments directly in one form or another. That's going to be much more difficult going forward. So it has to come from somewhere else, and that's going to be the private market. And of course, if you combine those two things, the carbon markets with the gap in the financing, essentially, I think that can be a really strong driver. And clearly, I think that the preference is to see more cap and trade schemes, and we've seen the effectiveness from the presentation of those cap and trade schemes. You're setting a cap, you're seeing that cap tightened up. It's the idea behind the boiling a frog. You put the water up slowly, turn the temperature up slowly, so that transition can take place over time, at least cost to society. And again, that was one of the really important points I've just taken from that presentation, which is that it's, we're seeing the emissions reductions take place under a cap and trade scheme, because a cap is enforceable, unlike with a tax where you're imposing a price, but you don't know what the outcome in the emissions is going to be. And so I think that's really important that we see more of these cap and trade schemes, but they take time. Again, as you see in that presentation, it's been over a 20-year period that we've got to the point where the ETS has become really effective. So other governments are going to take time to put those in place. Meanwhile, the project-based markets are there. They're ready. They're already in place, and they can be ramped up quickly. And I think that's the thing. What happened after essentially the carbon markets collapsed at the beginning of the 2010s is we saw things switch to the voluntary markets. And in fact, I think that was the other point that was probably not picked up on quite so much in the presentation, was the linkage between the EU ETS and the clean development mechanism, the Kyoto Protocol's clean development mechanism, which is ultimately where many of these project-based mechanisms and methodologies have come from. That linkage, that connection between the EU ETS created the demand that we saw in the CDM, and we saw many billions of dollars going in there. Now, at the time, it was a little bit too early. There were issues around the way that the linkage was made, and that the actual demand pull was too great for the ETS, particularly in light of the financial crisis of 2008, and so which reduced demand overall, and then meant that there was a surplus of carbon credits in the EU ETS for a long time. I think we've learned a lot from that now, and we are starting to see linkages between the project-based markets and compliance markets. So Singapore has a carbon tax. You can use carbon credits against some of that. Even the Chinese in their CETS are going to allow project-based credits to be used for a proportion of the obligation. So I think we're going to start to see that more and more. The voluntary piece is really important, but I think that ultimately we need mandatory and compliance markets in place to really get the financing that we need, that that to see that 1.3 trillion come to market over the next 10 years. And in fact, we need far more than that in the long run, but it's a good start. So yeah, that's my thinking. I think we'll see more convergence. It's a good thing. Project-based markets are here to stay. They do a lot of things, a lot of the heavy lifting that the cap and trade markets cannot do. We allow markets money to go into new projects and new technologies, as well as small scale projects and all sorts of it just creates lots and lots of different avenues for finance, and I think they're really important. So yeah, very keen to see them be supported and integrate into the wider compliance markets. I'll stop there.
Thank you, Chris. Ineke, want to add
Yeah,
something?
thank you. Well, there were three things that I would like to mention, but for a large part, I think echoing Chris. First of all, I think the agreement on Article 6 really shows that the UN believes in the carbon market and the mechanism to finance also for climate finance. So I think that is almost like a validation for the market, which is great. Second, indeed, the plans to unlock finance and to also largely rely on private finance is both, I think, a good thing, but also a challenge. Like Chris mentioned, it would be great, or depending on the goodwill of corporates, commercial corporates is also a bit scary to me. There has to be a clear incentive for these companies to start with their climate action plans. So a little bit of regulations can't hurt, I think. But I think what we're doing at Smallholder Agroforestry Finance largely reflects this trend already. We're setting up a blended finance facility, which combines public finance in the form of grants, but also in depth with private finance. And I think that's a really innovative way, and it echoes basically what was decided at COP29, that it has to be a joint effort of the public and the private sector. So that was the second highlight. And then I think thirdly, and we'll talk about this later, I think also there was a clear link between the compliance and the voluntary carbon markets. In the earlier presentations, we saw a lot about the cap and trade, so the compliance market. We at SOF, and together with Acorn, that will implement these carbon projects and also issue and sell the carbon credits that derive from this, we focus fully on the voluntary compliance market. So these are not sectors that are mandatory involved in any cap and trade systems, but that out of their voluntary goodwill decide to first reduce and then on top of that also offset their emissions. I think it's great that there's now an opportunity for these buyers to purchase in the voluntary carbon markets while there is a corresponding adjustment. So these there's not any double counting compared to national contributions or nationally set targets in the climate plans of each country under the Paris Agreement. So it's great that that link is now finally there between the compliance and the voluntary carbon market. And I think that will also lead to more quality standards, which have two sides of the coin, basically. One, of course, that will add to costs and efforts to align with these quality standards, but I think it will give great comfort to the market, and it may also lead to increased demand and pricing, which in our case, because we pay out quite a lot to the smallholder farmers, at least 70% of the income from carbon credits should go back to these farmers. I think this is great for us, that it could increase demand and price, and therefore contribute to the livelihoods of these farmers.
Thank you very much, Ineke. Michael.
Yes, sure. So I think one of the things around these COPs is to understand that it's it's called a conference of parties. So it's an agreement or let's say a starting point for something, right? And 300 billion in this NCQG is something that starts and kicks off something, right? And I think the EU overall seemed to be rather happy. Some other parties were not as happy, wanted to have more, but it's a starting point. Then the one key focus was the Article 6 of the Paris Agreement, right, where we which is kind of to facilitate the voluntary cooperation of countries that have NDCs or these nationally determined contributions and how they want to trade them, right? So 6.2 basically says then, okay, we can now kind of trade them, and we will try to put a mechanism in place and so on. But one thing that was really key was 6.4, and there was something that was missing before, is basically it puts a floor on the quality that we want to have for the voluntary, or what I call it the verified carbon credit market, right? Because it's in future it's no longer going to be voluntary, or it's going to be voluntary in the respect that I can either go the allowance market, which just allows me to pollute, or I can offset, which is I think a step better, and it gives me that choice, let's say. But I prefer the term actually verified carbon market. In any case, the Chinese are a step ahead, and you can see that the VCM in China trades somewhat close to the allowance market, and that is because it's relatively well defined what kind of removal projects, nature-based removals projects, are suitable to be pledged or to be basically used as credit, right, against emissions. And this is where we need to go to. The agreement, or basically the recommendation out of the COP21 was to put in place, or they had to have the supervisory board expedite on bringing forth clear documentation and structure. Out of the Kyoto Protocol, the problem was additionality, the regional concentration, the very complex bureaucracy that we had. All of that is to move away for this kind of what we call now the PACM, right, Paris Agreement crediting mechanism, right? That's the new CDM, so to speak. And that we hope will have a really good basis on what kind of projects to deliver. Now, for the private markets to come in, step up, and shake hands with the public sector, the regulators, and so on, you need clarity of what kind of projects you want to have. You need clarity of what kind of how do I do my planting? What should be embedded? How should I verify, etc.? How often? And all of these kind of what KPIs should be in place for my biodiversity as co-benefits and so on, right? And these kind of things are now much better defined. You can also see this now in the most recent EU regulation on carbon removal, carbon farming, right? Very, very much detailed on what we want to have. And this is the right path. And that's once you have clarity on such a new, still niche market, but upcoming market, then the private sector can step in. And for us, it makes it a lot better. I will have to, come up with, writing around investment solutions. I would have to write, what are my mandates? What am I looking for? How am I verifying? I'm somewhat left in a gray area sometimes, and I will have to do as best as I can forward-lookingly. That shouldn't be the goal. Imagine we want to have a project, nature-based carbon removal, reforestation. I have to plant now for my upcoming credits in 3, 4, 5 years, right? And so I'd have to put in place structures that allow me to capture that in 5 years. So this clarity was really needed, and it's a step in the right direction.
Perfect. Thank you. Thank you very much, Michael. So back to Chris. Given your deep involvement in both compliance and voluntary carbon markets, can you explain us how these two spheres interact today, and where do you see potential and eventual friction or synergy between them?
Yeah, so I think I mentioned it earlier, which is this whole kind of idea where you get this linking. We go back to the ETS where it first took place. There was a linkage, direct linkage between the EU ETS and the Clean Development Mechanism, and in fact the JI mechanism as well, but predominantly it was the CDM. So we were seeing many credits that were coming in from projects developed in China and India predominantly, and renewable projects, so wind and solar. And now there's been a lot of controversy around that, but there are also studies that demonstrate that did actually help to kick off much of the investment that we've seen over the last 10 to 15 years in India and China around renewables. And of course, we know now where China is in particular when it comes to batteries, solar, and wind. They're extremely strong. So there were some very positive benefits out of that, but there were also some unintended consequences. I think the big difference between what we're seeing now with the CDM and with PACM and the Article 6.2 is that there are limits, and that's where the corresponding adjustment comes in. There are disincentives from overcrediting, which there weren't under the CDM mechanism. There was a very strong incentive to produce as many carbon credits as possible to generate the value there. Now, while the system itself was supposed to reduce that through the additionality tests and the various other mechanisms that are in place, it was always always going to be difficult to manage that. I think under the Paris Agreement, that is acknowledged, and I'm not saying it's going to go away completely, but there are tools in place to support that or to prevent that happening. And so I think we will start to see those linkages emerge, and in fact we are already, as I mentioned before, Singapore, China, and potentially other countries, Korea, Japan, and elsewhere. Perhaps it's only a matter of time before the Europeans look at this again, particularly on the removal market. So carbon dioxide removals is an area where we're seeing a lot more interest. And there are still, I suppose, concerns around the avoidance and reduction market credits that come just purely from reducing emissions, such as renewables or avoided deforestation or clean cooking methodologies that will just reduce existing emissions against a particular baseline, versus those where they're going to be removed from the atmosphere, which is, I think we all understand, to get to net zero, there's a very large volume of removals that will need to take place, certainly from starting from 2030, but by the time we get to 2050, it's going to be in the billions of tons a year. So we're seeing interest there to try and scale those markets up, but all of these are going to get linked together. And I think what also we see is the voluntary markets, as Michael has pointed out, there aren't regulations. They're much more difficult to scale. They are difficult for people to invest in because of the lack of certainty around the rules that are in place, and I think that's starting to change. Certainly what the ICPCM is trying to do is create a quasi-regulatory framework that governs this global market. But then also you've got the Paris Agreement and the 6.4 mechanism, the PACM, as Michael has explained it to everybody, that sets out very clear standards. And ICPCM, PACM, these various different bodies are trying to align as much as possible to create that certainty, to create that standardization of the various different methodologies and standard setters. And we know there are a plethora of them. You've probably heard of them: Vera, Gold Standard, and other organizations who are out there assessing projects and actually issuing carbon credits, as will the PACM mechanism. So they're actually doing the same thing, but they're just they're under different regulatory models, if you like. But I think there will continue to be some convergence. They're certainly talking at at an informal level. Whether that becomes more formal in future, that's obviously to be addressed. That may well happen through international regulations and financial regulations as well. But I think that's really, really important. We're going to see those that continue to occur. As I said before, there's still going to be a lot of room for the project-based markets beyond just the PACM mechanism, because actually for the other piece of the Article 6, so Article 6.2, which is government to government, they can decide to use any standard they like. Now, they may well decide that they're only going to use 6.4, but the point is, we already have a bunch of other standards that are operating, that are effective, and actually can fit the bill. And in fact, many of the buyer nations are actually facilitating that. So you've got Switzerland, who are using effectively Vera and Gold Standard methodologies for some of the projects that they're investing in through the CLIC Foundation. Singapore has also whitelisted certain standards that will be applicable for their carbon tax. I know that other countries around the world are doing similar things. So that will enable that that standardization, a convergence of the different methodologies out there and the projects that are being developed, that will allow that interoperability and potentially ultimately the fungibility of those credits between different standards and different locations. And that should all create a more homogenized market globally in the long run, which will allow investors like Michael to get more involved.
Thanks a lot, Chris. Thank you very much. Ineke, now at SAF, so Smallholder Agroforestry Finance, you use the voluntary carbon market to finance agroforestry projects for smallholder farmers. Can you describe how this model enhances financial inclusion and builds climate resilience, and what kind of innovative financing mechanisms are at play?
Yeah, thank you. Yeah, indeed. So perhaps good to outline a little bit of what we do at SAF. We see carbon credits really as a means to an end. So basically, we are bringing together 100 million euros in funding from both private sector and public sector, and we will use that to finance agroforestry projects. So where small-scale farmers start planting trees, intercropping or border cropping with the original crop that they have. So planting trees among coffee, cocoa, or maize. Then Acorn, which is a part of Rabobank, will monitor that and also work with Plan Vivo to certify basically how much carbon has been sequestered by these newly planted trees. So as Chris just mentioned, these are removals. They actively remove carbon from the atmosphere. And based on how much carbon is stored in the trunk of these trees, they issue per ton of carbon 1 carbon removal unit, which is a type of carbon credits. They then sell these to large-scale corporations that are first reducing their footprint, and on top of that are also looking to offset. And then this carbon revenue, the carbon credit sales revenue, is distributed to the farmers and to Acorn for their certification and monitoring efforts, but also to local implementation partners, which are oftentimes NGO or farmer cooperatives. Sometimes even governments are involved, which is also key. So basically what this means is that a portion of carbon credits, when SOF lends to these projects, we will use a portion of this carbon income to repay the loan. And once the loan has been fully repaid, the farmer gets his full share of the carbon income again. So we use the carbon credits to be able to finance this group of small-scale farmers that normally is not really able to attract any loans. And if they are, it's usually through loan sharks, and it's at sky-high interest rates. So it allows basically this future carbon credit revenue allows us to finance these people that are oftentimes not able to get a loan, and to finance them also at reasonable interest rates. So in that sense, it results in inclusive finance. In addition, the projects often have, for instance, gender targets, so it also includes women. So that really contributes to the inclusive finance. On top of that, this leads to climate adaptation and mitigation. What you oftentimes see is that, for instance, I visited a project in Uganda where these farmers have coffee plots against a hill, and there were multiple cases of landslides due to climate change. So many of the farmers have lost friends and family. Once you now start planting trees, intercropping with the coffee, this really protects the farmers from climate change effects such as landslides. So that's really the climate adaptation component. And in addition, the carbon credit revenue, the share that will go to the farmer, also during the repayment period, they will still obtain a portion of the carbon credit revenue, really contributes to the resilience and the livelihoods of this farmer. And the carbon sequestered by the trees is also a real climate mitigation effect. As Chris alluded, it really removes carbon from the atmosphere, adding to the net zero targets.
Fantastic. Great project. Thanks a lot, Ineke. Now to you, Michael. You have really an extensive expertise in quant finance, digitalization, blockchain. How can these technological advances improve transparency, liquidity, and overall investor confidence in the carbon markets.
Great, yeah. So it's important to understand that this market touches a lot of aspects, and because it touches a lot of aspects, you have to somehow find ways to master this niche and upcoming market. And as Chris has outlined, these projects are often intransparent to many outsiders. Often they are financed through, let's say, private equity or private credit type investments, and it's not easily tradable. How can we make them tradable? Tradability in such investments is always by inclusion of more information, accumulation of information of what has happened as we started the project, as well as on the ongoing, let's call it, credit management. Our focus on our investment solutions is to go for very large scale institutional type projects, which we try to scale as much as possible, either operationally as well as through our basically data approach. And it's extremely important to try to make this into components that are easily or more easily manageable. And each of these components has some informational value, and adding this informational value to the respective project is very important. So we will start with a project where the initial pricing into the project is digitalized. It's clearly outlined what KPIs are in place, etc. Then as we manage the projects, information will come upstream, right? Certified verifiers, independent audit as requested will come in, give their viewpoints. Are the trees growing, for example, right? Etc., etc. And this needs to be added. So we have, on the one hand, an informational need that needs to be added in a way that is immutable. And one of the solutions for that is really out-of-the-box implementation of blockchain technology. And it's even acknowledged on the EU level in their carbon removal, carbon farming directives or the subsequent back office they would like to put in place. And so that's one aspect. It's really one of the very beautiful use case of the actual advantages of the blockchain technology. Now, the second part is that the individual loans or financing structures for such projects are often not very easily to be priced. First of all, what should be the coupon, right? It depends on the market, the liquidity that is in the market, emerging market spread, country spread, political spread, etc. That's one aspect. Second aspect is often these projects have contingent payments. So, for example, I could say, I take this project, I think the carbon credits that you will be vesting plus some silviculture, etc., will yield me this and that much. Call it $20 on per metric ton. Now let's say this goes into a trust fund, pays coupon, pays back debt, and there's some money left. This will be paid usually between those who implemented the loan, as well as the project developer, as well as the local community, right, which you call co-benefits. Now, how do you price that, right? So these markets are relatively young, developing. They are very much they're very heterogeneous, right? You cannot compare the individual sub-markets of the verified carbon credit market because of regional aspects, regulatory aspects, duration aspects, transparency aspects, etc., right? A voluntary carbon credit under the CDM, the Kyoto Protocol, might not be accepted under the PACM, for example, right? So it will trade at a very different price than one that is under the PACM. And so these aspects have to be priced somehow. If we don't find enough information, I will have to come up with let's call it standard quant finance tools. Sometimes they go into statistics or towards AI for financial markets in terms of finding equivalency of prices, or if this and that moved in the market, then probably this was moving somewhere here, right? Basically sparse data models. And so all of these aspects come into the pricing of these of this niche market. And it's very interesting because actually out of this market, we will learn a great many things which we then can apply back to the more traditional private credit or private equity markets, right? So it's a niche market where a lot of already known techniques come into play in a different combination, in addition to a high level of digitalization, data management, and AI approaches. So that's why I'm very keen, and we are venturing into this market, because it's basically the amalgamation of all that I've built. You know, I've worked 20 years in portfolio management, so all of I've done a PhD in between, and AI methodologies, and so all of that. So what I've built comes into play now. In addition to that, the transparency on chain allows us to create a certain tradability of the assets, and that's important because we have large scale projects where often DFIs come in, other co-investors might come in. Now we can dictate through blockchain systems who can come in, right? Minimum investment is this. I only want MiFID professionals to come into this and that, etc., right? So we can dictate who can be in, who can trade, and then make these assets tradable on standard regulated exchange facilities. So this is basically really a combination of a lot of factors that come at play here, and that need to be individually managed, but creates actually, it will foster innovation into the more traditional markets.
Thank you very much, Michael. Then to all of you again, from your respective fields, what are the main obstacles preventing carbon markets from evolving into a widely accessible asset class? Can we cite market fragmentation, lack of standardization, or regulatory uncertainty as the key issues? Chris, you want to start?
Yeah, so I think, I mean, you know, those are definitely some of the issues. That it's not an exhaustive list, but I think it is that certainty, the regulatory certainty that's required. You know, whether that's dealing with the, you know, the so-called project-based voluntary markets, or whether that's looking at PACUM and the other markets that we've discussed this morning. I think that yeah, one of the key areas that we look at and we concern ourselves with is what's the actual legal status of a carbon credit, a project-based carbon credit, particularly one that's perhaps generated in countries in Africa or across other parts of the world, where, you know, you really need to know what the legal status of that, who has the title, and how do you transfer title. It's a really important fundamental aspect of carbon trading, and we're starting to get to the bottom of that. I think that, you know, PACUM again and the Article 6 makes it very clear that you have to have legislation in place locally that govern the issuance of carbon credits, whether they're going to stay within that country and support the achievement of an NDC, or whether they are effectively exported through a corresponding adjustment and through the Article 6 mechanisms. So, you know, that's really important. That's going to help. But then I think there's all sorts of other infrastructure that you need. The registries need to be fixed. We need to have a global registry system where carbon credits can be transferred seamlessly, and you know that you have a unique credit, and that is then, you know, something that you can actually take title to, and you can start to put finance around. You know, that will help both Michael and Inika in terms of the projects that they're doing. People will be have much greater certainty over being able to deliver capital into those markets, and then obviously you need to really have that demand pull. And so that's why the linkages to the various compliance markets are important. Or indeed, if we are going to see corporates having to step up under their own net zero commitments, and seeing that pull come directly from corporates. There are a lot of corporates out there who've made net zero commitments, and it's not very clear how they're going to actually achieve them without using some kind of, crediting mechanism. So, you know, that could be a driver of demand. But even with that, you need that certainty, you need that standardization of demand, so that again, we can start to see standardized products and commoditization of the market occur that will allow us to be much more have much greater certainty over the development of market, things like futures contracts, so that people can manage their price risk. We saw how volatile the markets can be on the EU ETS. I see no reason why that wouldn't happen in the credit-based markets. But there are tools out there to manage those risks in other markets. They would be replicated into this market in just the same way. But we're just not there yet in terms of that standardization and those other key fundamentals that we need to fix first. Once we do, and I can see that happening all around me, then I think we'll be set to see rapid growth.
Thank you, Chris. Nick.
Yeah, I can only say I fully agree. Especially on the buyer side, standardization is key, and also harmonized quality standards and regulations, so that a buyer can actually have more comfort about what is a good quality carbon credit, and how do the different types relate to one another, because it's very different if you're buying direct air capture versus our smallholder farmer credits, and how do you compare the quality of both, and also, like you mentioned, the pricing of those credits. So standardization and this market starting to behave a little bit more like a commodity market, I think, is crucial. And then on the developer side, I think the regulatory component is key. For instance, we've seen a lot of projects that have tried hard to get letters of no objections from the local government. So the local government acknowledges and recognizes that a project is there and has the right to be there. That is extremely hard to obtain. So it's very nice if a local government is involved. For instance, Acorn has such a project in India where they work with NABARD and NAPCONS, which is the consultancy firm of the government of India. And that looks good on the government, both as it also solves a major uncertainty for a project developer. And the same goes for instance, the introduction of carbon taxation in certain countries or other carbon regulation, like you currently see in Kenya and in Ghana and in Zambia. It would be great if that is harmonized at minimum, or yeah, if there's more government involvement, so this is not predicting any uncertain, or it's not unpredictable and uncertain, but so that project developers can actually make sure they comply also in the long term, because our projects typically take about 15 years to develop and to then be repaid. So that's a long time horizon, and in that time, a lot can happen. So more regulatory certainty is something that could really benefit any project developer.
Thank you, Nick and Michael.
No, I can just confirm what has been said regarding futures. There is actually a futures market on voluntary carbon credits in the US. It's around the expensive system. It trades on CME, and key is here to have a basically a minimum standard. Ideally, we would have something similar trading on Leipzig or so in the EU, in line with the EU regulation that came out in December. Clearly defining what we want to see there, right? If it's now a nature-based carbon removals through reforestation, etc., etc. And so these tools are all readily available. It's a matter of bringing people to the table, discussing what we want to have. We are engaging, for example, with frequent trips to Brussels to engage with the respective key persons there to in their conferences and so on, giving our viewpoints. All right, it's kind of work that has to come from both sides. It's not that magically the private sector steps up and is there and then it all happens. You have to get involved, talk to people, understand what the end client, what the corporations want when they if they want to source verified carbon credits, what do they want to see in line with what, right? Airline industry, probably CORSIA, right? So you have to match those criteria. Others want to see EU criteria. We don't know what it is. What should I plan? So all of these items are kind of in a gray zone. And as soon, I'll give you one example. Germany at some point came up with regulation around crypto, and even though it wasn't maybe perfect for everybody, it created a lot of certainty in terms of what you can do, right? And this is where we need to get in this market as well. It's a niche market. It's upcoming. It will be a big market. We want this market. It's part of the solution that we foresee against the problems we create through our lifestyles, right? And if we don't come up with this, then the private sector is simply not gonna be there in scale as needed. If there's clarity, what should be produced, how we can implement projects more clearly. And this is really a key factor. This will reduce the fragmentization. This will, and then a second step is if this should be somewhat, let's call it bankable, then registries, back office systems, etc., need to be put in place, right? If we want high transparency, then probably blockchain is a good technology. How does that blockchain approach, and what do we accept here? How does it talk to legacy systems, for example, right? Et cetera, et cetera. And how do we make these more modern, out-of-the-box systems trade on traditional exchanges? So all of these items have to be defined. And if we have these big targets by 2030, there's quite a bit of heavy lifting to be done. And it means that, organizations like yourselves, LSFI, are very important, that we bring together the roundtables of regulator, government, policies, etc., private sector people, to discuss how we can achieve this. And this is really, really key. These efforts like yours here is really key for us.
Thank you very much, Michael. Thank you. Staying with you, both Ineke and Michael, drawing on experiences from innovative finance and asset management, what lessons from other asset classes, such as green bonds, could help broaden the investor base in carbon markets, in your opinion?
Yeah, I think again, standardization is key. That's a very important aspect. Also, more oversight, as you see in the traded markets, is, I think, imminent. It has to happen. And I think for us as financiers, that's great, because that standardization, or projects that adhere to widely recognized market standards, such as the core carbon principles from the ICVCM, for instance, would really help to increase standardization, also perceived level of quality, might even increase price. So I think those are good developments. What I hope is that there will be harmonization when it comes to the regulation and the standards that projects need to adhere to, because otherwise it doesn't really make it attractive for project developers, or for investors for that matter, to start these climate projects. So harmonization or equivalence is key. So I think those are really important. And then when it comes to SOF, I see there's also a question in the chat about that, so I think I'll take it now already. What we learned from other projects is the blended finance component, right? At COP29, it was very clear it has to be a joint effort from public and private funding. So our facility, which is not yet live, but brings together 100 million in funding from both development finance institutions, but also private banks, for instance, like Rabobank, that are bringing together this 100 million. So there's risk sharing there for the more senior participants, and there's more concessional finance provided, for instance, in the form of grants in the more junior tranches. And I think this works as a really catalytic systems, where these projects, for instance, previously were only able to start with grant funding, which is great, but it's not always available when you want it, in the quality, where in the quantity you need it, or for instance, in the regions, sometimes grant funding is very ring-fenced to a certain country or a certain focus area. So I think the blended finance component enables us to use that same grant money, but then to increase it with a private participation. So that's wonderful. I'll leave it at that.
Thank you, Nikki. Michael.
Yes, so the blended finance components is important, because some of the end investors in our space, institutionals, they would only be investing in senior tranches, for example, right? So for the junior tranche, or even the equity tranche, somebody else needs to step in. They but it depends. I could imagine also the junior. It's a pricing issue, right? If the junior tranche is priced at a level where you think, well, I'm going for that, right? Then sure.
Yeah.
For that, you need to have kind of clarity on what type of credits you're producing, how you're using, in which region, etc., etc. As you have more clarity in all of these components, a price can be found. It's so that's one aspect, and that relates to standards, bond mathematics or equity pricing mathematics, right? Certainty, and then how over time we accumulate information in line with that. The second, so the EU green bond standard, right, was more for sustainability linked investments. So the proceeds of the bonds should be going into kind of sustainable projects, right? But the credit risk was still pari passu normally with the respective institution, right? So if some car producer issues a bond and wants to put solar panels on his roof, right, still car producer credit risk. Here, as we do these kind of bespoke loans, let's say, or private credits or private equity type investments into projects that generate carbon credits and often have co-benefits. Another component comes in, which is the measurability of the impact, let's say, as well as the KPIs relating to all of these co-benefits that we claim we would be. For example, the EU in their directive from December want to see for nature-based carbon removal type projects, definitely one co-benefit must be biodiversity, right? So we have to measure it, we have to accumulate data, we have to show trends over time, ideally with a lot of statistical tools in place to really show robust upward moving trends, hopefully. And so this is a component that needs to be embedded in and needs a new pricing. Now we can lean on, for example, commodity markets. We can lean on, you know, the credit markets. We can, as I outlined, when you have these contingent payments, we can lean on option markets, option adjusted spreads, etc. So we have these technologies, but they will be newly applied into this market to render this market, you know. So what I'm saying is we have the tools available to price these things, down to even you know, the insurance. Some of these insurances, it's somewhat required to have as a mitigating factor insurances in place in case there's you know, wildfire, for example, right, that releases CO2 back into the atmosphere, right? What do you do then, right? Do you have measures in place operationally on the ground, but also do you have insurance in place against that? How do you price that insurance, right? That goes back to, you know, kind of event-linked type bonds and so on. So these tools are available. The problem is we need to know exactly what we want to finance, how, under which regulatory framework. And then we can get there relatively easy. And that's really a key task. That's one thing. Second thing is, you know, with this whole, how should we say, turbulence around US aid, et cetera, who else, who's still there? I think the DFI, probably the pockets are less full in future. So it's a lot more up for the private sector to come up. As I said, for everything there's a price. It might mean that some of these projects, there's not as much for the project developer given the required loans for some of these deals. And so we have to find ways to get there. But clarity, structure is information, and accumulation immutably on systems is what is important to make these deals work.
Thank you, Michael. So being conscious of our time, and before moving to the questions from the audience, I have a last question for you all. So looking forward, what key trends or strategic shifts do you anticipate in the carbon credit market? And how can industry stakeholders best prepare to capitalize on these emerging opportunities? Chris?
So I think the best way to describe it is, and I hope it doesn't come across wrong, but it's professionalization of the market, certainly on the credit, the carbon crediting side. And so, you know, you have to make sure that the project developers have more credibility around them. They've got bigger balance sheets. They've got better technical expertise. The monitoring and reporting and verification side, the so-called VVBs, the verifiers and the validators. Again, we need more people with expertise. We need more people who are capable and have that credibility. The standard setters, again, the same. So we see this throughout the market, cascading down a professionalization. And then, you know, again, linking into the compliance markets, we will see that infrastructure and everything that we need to make the market work as other markets do. While obviously there are specific issues that we have to think about in carbon markets, and Michael and Ineke have highlighted them very, very well. It's still a market. It's still a market in the same way that we see other commodity markets develop, and I think we'll see the same tools and structures develop around them. I note somebody talking about securitization. Absolutely, why not? We'll see these sorts of instruments being applied to the carbon market. So that whole professionalization and standardization, I think, is what we're going to see going on, and it already comes back down to the fact that these projects have to wash their face. It's not about just pure philanthropy anymore. It's not about just government aid. It's not just about sovereign to sovereign investments. It has to be the private sector that steps up, and they're only going to do that if they know what they're getting into.
Thank you very much, Chris. Ineke?
Yeah, in addition, a key trend or a strategic shift that is happening right now is obviously the current US administration is one to watch. We've seen the horrible effects on USAID, which really leaves a gap in the financing that's required to finance these kind of climate projects. So for me, it's interesting to see if, in this case, for instance, the US-based buyers will step up and fill this gap. Interesting to see, for instance, there's a large RFP in the markets right now from Symbiosis, to see if those kind of buyers will step up. And at the same time, yeah, we're counting more and more on the private sector. Relying on the goodwill only of these companies might not cut it. So some additional regulations to give a good push in the right direction might help. And there it would help to provide clear guidelines for developing companies to know what are the boundaries and what are the compliance measurements that they have to adhere to, but then not to to result in over complexity that makes it hard for project developers and for investors to start these type of projects. So I think those two trends, the regulatory framework as well as the US movements, are interesting to keep track of.
Thank you very much, Nikki. Michael.
Yes, sure. So I think professionalization is really a key word. And in our aspect, it's also it's important to understand that we look at it from a profitability point of view, and it's in relation to abatement. What is the cost of optimizing your production structure versus probably offsetting within the regulatory framework? But it has to be profitable, and this approach is probably something that is I don't want to say new, but it's to some extent a fresh wind to market that is often philanthropically driven. And this means that we will go through projects and probably be extremely selective given the less uncertainties, but there are still some uncertainties remaining. I mean, we have much more clarity now in the EU how we should go about certain things, but this professionalization means also putting numbers to projects and seeing if they make sense. And there will be a lot of exclusion of projects that don't make sense, given various aspects. Could be the region, could be a political risk, could be unclarity on regulation, etc., etc. And I think this is a key component. As the private sector comes in, we want to go for projects that give us, I want to say, bang for buck, so to speak, right? Because it's a lot of effort and a lot of components that I have to put in place to get things working. And this is the trend that will come. And the projects that sync with all of what we've discussed, the back office systems, the tradability, the informational supply, and so on, they will get funding. And I think this is where the market will trend to, and then the rest of the market will have to catch up.
Thanks a lot, Michael, and thank you to the three of you for your insights. Now let's move to questions from the audience. So we have some. First one from Catherine. Noting that there is a hefty backlog on verification of projects and both Verra and Gold Standard are under-resourced. We have Sasta Insert and others trying to reduce time frame, but what other efforts are underway to reduce the bottleneck? I want to take this.
Well, I could say here that it's true that if we cannot have, it's a key component for all of these, whatever investment solution you put in place for a project. It's one of the primordial components that you have to have a certain verification. It's clearly in all the regulatory approaches and the what should we call them, the more voluntary association type approaches. We need to have this verification in place, and you have to get a slot or a solution for that. Absolutely. Otherwise, I can say from the private sector, if I cannot guarantee that the project will not happen. It's really a key component.
I think that the verifiers and verifiers, the standard setters, they recognise this. I know that Vera is doing a lot to rectify the issue. They're trying to digitize. They're trying to improve that whole process. At the end of the day, it's absolutely in their interest, because if they don't issue the credits, they don't get paid. So it's a big concern for everybody, but it's also something that I know that there is a lot of focus and scrutiny on and action. But I guess it's watch this space, and it goes back to the point earlier about professionalization.
Perfect. Thank you very
I
much.
think one
Then we have
aspect I would add to is probably it's probably not a nice example, but we've seen how fast AI tools have been able to help the US administration. You can have your own viewpoint, but it's quite shocking how fast they went through massive amounts of data. And I think as we learn these models, as these verifies embrace more scalable tools, let's say, I think that could help giving the key people, the key creative people in their or value added people, let's say, more tools available to get more projects done. I think that's also a key component, and we are working on that to supply them with as much information as possible in a structured way so that they can be faster in their verification.
Yeah, I agree. To add to that, it's not only, I think, artificial intelligence or AI, but also, for instance, the use of remote sensing technology, satellite footage to monitor certain areas is becoming better and better, and also has the ability now to not only monitor the growth of individual trees or plots, but also to look at, for instance, biodiversity corridors, for instance. So I think the use of technology in the broadest sense can really alleviate the pressure on the certifiers.
Thank you very much. We have a second question from Adriano about the future of VCM in the European Union. How fast do you think the EU will realistically move to implement Article 6.4? Can you envisage a scenario under which the EU will mandate companies to offset the residual emissions through carbon credits?
Well, the recent regulation that was signed, when was it? In January, I think. This 2024/3012 or something, is really out. They have, I think by 2028 they want to have a pretty concrete idea of how the allowance market and the CRCF, carbon removal, carbon farming type market should function together. So I think this is a framework. I think they want to have it in place definitely ahead of 2030 as one of the key dates that people set themselves with. And I think that's kind of the framework they have in mind. So they are collecting data, trying to implement as much as they can to have some kind of framework similar to the Chinese or the Singapore government, right? And I think that's roughly the marching route.
Thanks a lot, Michael. And then we have a third one from Jean-Philippe. Do you think it will make sense using securitization as an intermediate tool to overcome the legal uncertainty of actual carbon credits and create a pool of obligation that as a whole instrument can be traded rather than individual credits?
It doesn't change anything because the pricing of a pool depends on the individual components, right? So there might be some. So as you have a pool, you have maybe some risk mitigating factors, some diversification on the other hand, right? And you can do your structuring and senior tranche and whatnot. But if you have cluster risk, because all of these are no longer accepted under some new regulation, then your value tanks because it's just a right, and your rights that you wanted to sell in the market suddenly has no value. So it helps at the margin. I mean, in the end, yes, you want to pool risk somehow and have a diversity across sectors, maybe across regions, across maturity spectrum, and all these kind of across the type of nature based and the type of tech based and all these kind of things, right? So that's why we're working on a plethora of different aspects to this market and how to finance individually. But in the end, it's you have one cluster risk, and if your regulation changes, your carbon credit value is nothing. right? As you can see from the old credits from the CDM or Kyoto Protocol, right? They're trading at basically zilch. So you might go ahead and buy them in the market and pledge them, but the shareholder meeting won't be pleasant. So that's essentially the key point. The fundament has to be there. Then you can do a lot of fancy financial stuff.
I totally agree, but I do think that that's the thing, is we will see, securitization being an important tool because of that portfolio benefit that you get. And when people are going to invest into a pool of carbon credits, I mean, the big issue that I think we've got at the moment, one of the big issues, is the fact that buyers, have to perform such a huge amount of due diligence, right? For every credit that they're buying, even if it's an issued credit, and certainly when they're buying unissued credits, that becomes really complicated, and for many buyers it just puts them off completely. It's fine if you're a Microsoft, if you're a Volkswagen, or big companies who are going to have big needs. They've put in place teams that are doing this, but to me it's the same idea of Volkswagen starting to produce its own steel, right? Why would they do that? They don't. They go and buy semi-fabricated products, because that's a much more efficient way of actually participating in the market. They'd only buy their own steel if they didn't trust what was being actually produced in the market. So I think that it's those fundamental issues, as Michael points out, that you need to resolve first, and the legal nature of credits is extremely important. If that's not resolved, then I think securitization is a non-starter.
So the Volkswagen is a beautiful example, because they actually go out and produce their own carbon credits, right? And this is because the market is basically in a very difficult structure. And imagine a Volkswagen, I don't know what they do, maybe 10 million cars, and you have, I don't know, 10, 15 tons per car, right? So we're talking 100, 150 million tons per year, and you want to reduce that by 90%, 2030. That's a lot of offsetting. Even for the remainder, right? So these are definitely issues, and here you need to think in portfolio context, right? You can't just hop into one project and hope that it works. You have to diversify. But in order to diversify, we need to fundamentally determine what is the substance we want to invest in. And once we have that, then we can bring, as we've discussed before, we can bring all of these old technologies and quant finance and digitalization, etc., to this market.
Thanks a lot, Michael. Ineke, do you want to add something?
No, I echo that. I think not so much to add at this point.
Thank you. So we have come to the end of this extremely interesting webinar, but before we conclude, I would like to thank again our guests, Ineke, Chris, Michael Althoff, and Michael Holling, for sharing their knowledge, their work, and insights, as well as you all, our audience, for joining this webinar. Lastly, let me emphasize the importance of our collective efforts in this journey towards a sustainable future. By working together, sharing knowledge, and committing to ambitious goals, we can make a significant impact in mitigating climate change. I finally strongly encourage you to visit our website, lsfi.edu, to subscribe to our newsletter and LinkedIn channel to get first-hand news on our activities and on everything related to sustainability and sustainable finance in particular. Thank you again, and enjoy the rest of your day. Goodbye.
Thank you.
Thanks. Have a nice day.
Thank you for organizing.